guys, so today I want to take you through a set of financial statements, show you what it looks like and how to read them or how to use the information to make better decisions for yourself. It could be you're an investor and you want to invest in a certain type of business, or you're a lender and you want to lend money into a certain type of business, but you don't know exactly how they've performed, what the business really is like. So I will show you a set of financial statements and maybe some ratios that you can use to see, or that you can use to calculate really the numbers that you are trying to get out of that business. So hope it helps, and hope I have used the simplest language really to make sure that you understand. But if you do have questions, drop a comment in the box below or DM me if you need further guidance on how to use a different set of accounts. The accounts that I've used are not audited and they are not public, so they will be the very basic ones. But if you need more information, just let me know. Hope it helps. So this is the set of financial statements that I was talking about that we'll go through quickly, and it's an unaudited set of financial statements. So hope this helps and you'll be able to use it when you look at any company's accounts or when you're preparing your own. Okay, so this would be the first page here, which is an unaudited company. So you do get audited if you get to a certain level, let's say in the number of employees that you have, or the turnover that you're having, or the amount of assets that you have on your balance sheet. But if you're a small business, you will be unaudited and you report in different sets of standards. So whether it's FRS 102, FRS 105 and so forth. And so what we're looking at is a smaller business that's not audited and what their accounts would look like. So if you move to the first page, you will have here a contents of page showing you what's in the report, and you can go through the report as you see by the numbered pages there. Okay, and then this would be the details of the directors to the company secretary, the office, and the accountant. You can also find most of this information on Companies House. So if you actually wanted to verify that it's the same company, you'll be able to see that it's the same directors and the same registered office, for example, and that's what you just have on here. Okay, moving on to the director's report. This is where the directors usually tell you what's happened in the business, so what the performance has been like. They could choose the level of detail they want to go into, and really just showing that they're reporting based on the standard as well, and who the directors are, and the signatures of the directors to say we believe that this is the true position of the business as at this point in time. Okay, and then this would be the accountant's report. So your accountant will put in here just stating which standard they've used, and to say that they've used the information based on the data that was provided by the director. So it's not the accountant saying I have verified the information in here, but I'm just saying that I have used the information that I was given to prepare the information. Any level of assurance is usually provided by an auditor and not the accountant per se. So this is just to show that they have prepared using the information from the directors. FRS 105 may not have an accountant's report, but this is what it looks like in general. Okay, so this would be what most people are interested in. So you have the income statement. Now this shows you the performance of the business in the year, and this right here would be the previous year. Okay, so that's the current year and that's the previous year. And essentially, if you want to see what's actually happened in terms of improvement, you'll be looking at the movement. So this here minus the previous year is what you will see as the improvement or changes in the business. Okay, now I will talk a little bit about ratios and how you can use that to analyze the performance of the business. Okay, but for now I'll just show you what the pages look like. So this is the income statement, as I've said, and then you have your text numbers here. Now if you're looking at an income statement, I wouldn't be focusing on the profit after tax, because people want to minimize the tax that they're paying in a business. So I would probably focus on this number here, how much profit has actually been made before any sort of deductions have happened in the business, because people claim like all sorts of things like capital allowances, amounts to directors, anything really. It would come in after this part. And so anything under here, so your profit after tax really is not a true reflection of what's happened in terms of performance. So I would look at the profit before tax. And then After that, you have the balance sheet. So the balance sheet shows you the position of the business in terms of what it holds in assets and what it holds in liabilities. The fixed assets are normally like your equipment, your plant and machinery, or your immovable assets. Normally also you can have intangible assets here. So this will show things like goodwill or the value placed on customer contracts, for example, things that are not tangible, and then you have tangible fixed assets in there. So that's the value of your asset is at the end of each year. And then you have the stocks, the cash, and then you will also see the total assets here and the net assets. So the net assets are what the business has after removing all the liabilities. So what do they actually have if they paid over everything that they owe to people? So this is what the net assets represent. This should also be really what the investor hold in the business. So you'll see these numbers will need to be the same because that's what the business owners own at the end of the day after they've paid all the liabilities. So typically your directors would come in and sign on the balance sheet page to say we are confirming that this is the position of the business. And what you'll see, I guess you'll see here, this is the signature page which I've just talked about. It will usually be below your balance sheet, but this is where it comes in. Then after that you will see, so you'll see here we have the notes and some financial statements after the signatures. You'll see what we call a statement of changes in equity. So what it shows the movement in what the business owners own. So it's looking at this movement from this number at the end of 2015 in this instance to this number, what has changed and what goes on in there. It will be the profit in the year, it will be changes in the share capital. So if you actually want to see the movement in these two numbers, should be the same as the profit that you have here. The only difference that you might see is if a dividend was paid, but if there is nothing, those two should be the same. Okay, and so that's what it represents, and you'll see it as a separate statement of changes in equity after the balance sheet in some financial statements. So after that, you will see the notes. Really what these are doing it's just explaining the policies of the business. So how they define certain things, how they account for certain things. For tangible assets, for example, they're saying how they depreciate or how they claim for depreciation in the business. Are they spreading it over a period of 3 years or 10 years or 5 years? As you can see here, you can see 20% in this instance, meaning they're depreciating over 5 years. That means in the profit and loss that we looked at, the cost of the plants and machinery is being claimed over 5 years. So that reduces the taxable amount, which is why I was saying you want to look at the profit before tax to see exactly how much profit they have made, because tax is impacted by a lot of things. Now, it's a separate topic. The tax value of this amount will be slightly different from the depreciation, but let me not confuse you. So this is just really the policy and how they are spreading the cost of a number of years. So it's different items really in your accounts, how they're accounting for those things. And what this is doing is giving clarity to each of the numbers that you've seen. So if I scroll back to the balance sheet and the profit and loss, for example, you can see you have note references in there. So you've got note 5 here. This right here is to show you that if you want more information, go to note 5. If you want more information on debtors, go to note 6. So that's what you're seeing in the notes. It's just giving additional insight on what's happened and what those numbers represent. So let's say in your tangible assets, as we've said, you'll start to see that, okay, this is how much they've bought in the year, this is how much they've sold in the year, and then what they've claimed as a depreciation as well. And that's a summary there. For your debtors, so what you have on the balance sheet is a grouped figure, but this normally would show a breakdown, and you can break it even further into VAT receivables, directors' loan accounts, and it will show you exactly. So this is what relates to the sales, the trade debtors. So that's what you want to look at as the number that you need. Now, again, it's just showing more and more detail for the numbers that you've seen on the balance sheet statement and so forth. And in some accounts, you will start to see a further breakdown of the actual income statement lines. So where you have like your administrative expenses, for example, what actually goes in there, and then it will detail by each line what they've included, the type of expenses they're incurring, and so forth. And so this is what a set of financial statements looks like. So you should be familiar with it. If you are an investor and you want to invest in a business, what are you looking at? Or you want to lend money to a business, what do the numbers actually mean? So this is where some ratios that I think might be useful to you might come into play. Okay, so firstly, if you're trying to look at the liquidity of a business, so can the business really be able to pay its liabilities? How much cash does it have, or how much cash can it generate? You're looking at what we call the liquidity ratio. So one example is the current ratio. And so essentially we're looking at the current assets, which are these ones here, the 163, and the current liabilities. So that will be this 136 here. So your current assets over your current liabilities is what we call the liquidity ratio. That means how much can the business pay to its creditors and be left with. So you've been given this net asset or net current asset over liabilities as a number, but you can get it as a ratio if you want it to make more sense to you. So for example, you'll be saying 163, which is this one here, over the 136. Ratio that you get, I'll just calculate it quickly, is the about 1.2, meaning the business can pay its liabilities 1.2 times over. So if you're worried about the amount of debt in a business or the amount of creditors in the business, you want to make sure that the business is able to pay. You're looking at a ratio that's at least more than 1. Different industries have different benchmarks. So some industries, because of the level of creditors that they have at a point in time, may need to be less than 1. It doesn't matter. But with some may even want to be up as high as 3, meaning there won't be any risk of not being able to pay its creditors. So let's say if you're trying to buy a business or something like that, you want to see if the business is able to cover after settling all of its creditors. And then another one as well would be an asset test, which is to say, if we take out the stocks here and any prepayments, can it actually pay the liabilities? So you'll just say the minus the current liabilities, minus the inventory or the stocks as well. How much are we left with? And that's your liquid, like your quick asset test ratio. Now, another thing, so maybe let me write this down for you somewhere. Okay, so I'll put them down for you here. It's current assets over current liabilities. Okay. And then if you also want to look at the debt ratio, you're looking at leverage. Okay, so this is when you want to see if a company is over leveraged or not. You're looking at this one. This company in particular really doesn't have debt or like external debt that we can consider. It just has creditors over 1 year. It may not necessarily be debt, but let's say it had a mortgage or it had other long-term loans. That's what we call debt. You would divide that by the total debt divided by the total assets, and that will give you the leverage, and that tells you if a business is over leveraged or not. Another ratio you can look at as well would be efficiency ratios. Okay, so efficiency ratios are looking at how quickly the business can generate revenue or how efficient the business is. So for example, how long does it take the business to recover its money from debtors? You will be looking at, so we call them debtor days. Okay, you will be looking at your net sales, which is what you see on here, the 1.6 million, and the debtors, the 159,933. So if we say 159,933 divided by the 1656 times 365, this is the debtor days. So I'm just calculating that times 365. I'm just using 365 days in a year. You get 33 days. So essentially what this business is saying is that it takes you 33 days to recover from debtors generally. So you can do the same thing for creditors. You're looking at your payables balance. Normally it's your current liabilities So on here it says note 7. Now I don't want you to assume that all of this relates to trade creditors, because it might include things like tax payables and so forth. So if you go to your note 7, you'll see what the trade payables are, and then you divide that by your cost of sales. So what's that saying? It's saying that these are the number of days it takes for this business to pay its creditors. So if you are, let's say, a potential creditor, you want to know how long it might take you to recover your money from this business, this is something that you would want to look at. So how efficient is this business? Other things in efficiency ratios would be how much revenue the business is generating from its assets. So we call this an asset turnover. So asset turnover is your net sales divided by your total assets. So this shows you how much business or how much sales is being generated per pound of the assets. Okay, and you can do that as a ratio if you want, but it's just showing you how efficiently the business is utilizing its assets. So those are some of the things you can use to assess what the business is doing. How efficient is it? How liquid is it? How leveraged is it? Is it over leveraged, and do you want to invest in it or not? You can also look at profitability ratios, and this is particularly easier for listed businesses where you're looking at the earnings per share, for example. So you'll be given a number of shares in a business, and you have what, I guess you can use the profit after tax and the profit before tax to say, for the 132 that they have as profit, how much is being paid per share owned. So you can divide this by the number of shares, and that will show you what we call earnings per share. So if you want to look for a company that gives you a better return on your money, you will have to consider this. You can also look at things like your return on equity or your return on assets. So you're looking at maybe your gross profit over, showing the profit here, or the profit numbers over what you have invested or what the business has invested, which would be the total equity that we see on the balance sheet. And that should give you a return on equity and what you're likely to get as a return on the business. So I'll take that 132,000 divided by the equity in the business, which is 237. I think it's 041. Yes, correct. So 132,912 divided by 237. So that gives you, wow, that's quite a good return. About 56% return on equity. Okay. So this is returning quite some good money on the equity. That might be more or less, usually less, but what is a good benchmark for you in terms of your return? Of course, this whole amount is not yours, but it might mean of the money that you're investing into the business, you're getting 56% of that as a return in a single year. That is a good return on investment. So hopefully these ratios help. I tried not to go into too much detail, but drop me a comment if you have specific questions on how to understand specific performances or specific numbers in the business, or if you want a list really of some of these ratios, I can share them with you. Drop me a message or a comment in the box below. So hope that's been useful. Let me know if you need more information. Thumbs up if you liked it. Thank you.